You think your problem is strategy. It's not. Your problem is time frame. Here's the brutal truth. I lost $22,000 in 6 months staring at 15-minute charts. Not because I was clueless. Not because I didn't study. Not because I lacked discipline. I lost it because I was trading other people's fear and greed instead of the market's actual structure. I was trading the heartbeat, not the body. Most losing traders aren't wrong on direction. They're wrong on speed. They're trying to build professional wealth with amateur attention spans. They analyze on the daily chart, then panic on the 15-minute. They plan like professionals, but execute like gamblers. They write a beautiful plan on Sunday, then tear it apart by Tuesday because of a few red candles that mean nothing on the higher time frame. This wasn't a one-time mistake. This was my pattern. My expensive soul-crushing pattern that repeated itself 17 times in 1 month. 17 trades where I was right about direction, but wrong about time frame. The math was devastating. 17 losses at an average of $180 each. That's $3,060 in 1 month. Not from being wrong, but from watching the wrong chart. Let me paint you the exact picture of how this financial suicide unfolds. I'd spend Sunday night doing proper analysis. I'd mark up the daily charts. I'd identify clean setups on the 1-hour time frame. Strong tech stock. Daily trend up. Clean 1-hour breakout forming at a pivotal point. I'd calculate position sizes based on logical stops that respected market structure. I knew exactly what I wanted. Small position, risk 1.5% of my account. Stop just under the last 1-hour swing low. Let the breakout confirm. Then maybe pyramid if it held above the level with volume. Simple. Boring. Professional. I'd even write it down. Entry price, stop price, target price, reasoning. Everything looked professional on paper. Then Monday morning would arrive. The market would open. And within 30 minutes, I'd have the 15-minute chart pulled up on my screen. At first, I told myself I was just monitoring more closely, being vigilant. But vigilance became anxiety. Monitoring became obsession. And obsession became financial suicide. Here's what would happen. I'd enter the trade based on my 1-hour analysis. The stock would behave exactly as planned. It would hold the level. Push up. Pull back. Everything still clean on the 1-hour structure. Then I made the fatal mistake that amateurs always make. I just checked the 15-minute chart. Instantly, everything felt different. Same stock. Same price. Same level. But a different story. On the 15-minute, the candles looked violent. Red candles everywhere. Sudden volume spike. Price dropping fast. Long wicks. The kind of price action that feels like the floor is about to fall out. My brain didn't see structure. It saw danger. Your brain isn't wired to handle the volatility of a 15-minute chart. Evolution taught us to run from immediate threats. When a red candle spikes down, your amygdala fires. It sees a predator. It demands you run. That survival instinct, which kept your ancestors alive, will kill your brokerage account. I'd watch one more 15-minute candle form. Red again. My heart rate would spike. My palms would sweat. The voice in my head would scream, "Get out. Get out now. You're about to lose big." So I'd panic and cut the trade for a $150 loss. 4 hours later, the stock was up 8%. My original 1-hour stop never even came close to being hit. On the 1-hour chart, that scary 15-minute move was just a tiny pullback into support. Normal noise inside a healthy structure. Exactly what a professional expects. The only thing that didn't belong there was my fear. This is what amateurs do. They downgrade their decisions every time a candle twitches. They let the 15-minute chart bully them out of perfectly good trades. They confuse movement with meaning. They take a high-quality thesis derived from a high-quality time frame and subject it to low-quality noise. Professionals do the opposite. They elevate their decisions to the higher time frame. They let signal drown out noise. They understand that the 15-minute chart shows you the market's anxiety, but the 1-hour chart shows you the market's intention. One shows you who's nervous. The other shows you who's actually in control. Think about it this way. If you're building a house, you don't make architectural decisions based on where each individual nail goes. You follow the blueprint. The blueprint is your 1-hour chart. The nails are your 15-minute candles. Both exist. Both matter. But one guides, and one executes. Here's what's really happening under the surface. By staring at the 15-minute chart, you are compressing time. You're experiencing every micro-emotion of the market, every shakeout, every fake breakout, every algorithmic spike designed to separate you from your money. Your brain processes that much randomness and does what scared brains do. It overreacts, it abandons plans, it forgets the big picture. Meanwhile, the professional is watching the same stock on the 1-hour chart. Price pulls back, forms a controlled candle into support. Volume stays moderate. Nothing broken. Nothing invalidated. No reason to touch the position. They've placed their stop where the 1-hour structure actually fails, and until that happens, they let the trade breathe. Your time frame choice isn't just a technical decision, it's an identity decision. When you choose to trade the 15-minute chart, you're choosing to be reactive. You're choosing to let every micro move dictate your emotions and actions. When you choose to trade the 1-hour chart, you're choosing to be proactive. You're choosing to let structure guide you instead of noise. The market punishes people who don't choose a dominant time frame. You enter based on the daily trend. You manage based on the 1-hour. You panic based on the 15-minute. You exit based on the 1-minute. That's the emotional cascade that turns good swing trades into bad scalps, into painful memories. In the next 4 chapters, I'll show you exactly why the 15-minute chart is designed to trigger your worst impulses, how the 1-hour acts as both filter and discipline coach, and the 3-rule system that transformed my trading from reactive gambling to calculated positioning. But first, you need to understand something critical. If you don't choose your dominant time frame, the market will choose it for you. And it always chooses the one that hurts most. It will pull you into the 15-minute chart during moments of fear and convince you that more information equals better decisions. That's the lie that cost me $22,000. Don't let it cost you the same. Here's a question that will change everything. If your risk per trade is calculated on the 1-hour chart, why are you making exit decisions on the 15-minute? That mismatch is where 73% of retail accounts die. Not from bad stock picks. Not from poor risk management. From watching the wrong chart after they've entered the right trade. They plan like professionals on the higher time frame, then panic like amateurs on the lower one. Let me show you exactly how this works with surgical precision. Picture an amateur trader. Call him David. He's not stupid. He's read the books, watched the videos, understands position sizing. He has a $15,000 account and risks exactly 2% per trade, which is $300. He's disciplined in his planning phase. David spots a clean breakout setup on the 1-hour chart. Rising trend. Higher lows. Resistance at 43.50 that's been tested 3 times with decreasing volume, classic coiling action. He calculates his entry at 43.60, places his stop at $41.50 just below the 1-hour support level. With 150 shares, his risk is $315, right in his wheelhouse. If the trade works, he's looking at a $900 winner based on the measured move. Textbook professional planning. But here's where David makes the same mistake that cost me $22,000. The moment his order fills, he switches to the 15-minute chart. This is the precise moment he loses, not when price moves against him, but when he changes his perspective. 15 minutes after entry, the first red candle appears. On the 1-hour chart, this candle is invisible, just a tiny wick within the normal range. On the 15-minute chart, it looks like financial Armageddon. Heavy volume. Long lower shadow. Price drops from $43.06 to $43.20 in one violent move. David's brain doesn't see market structure anymore. It sees danger. Your nervous system wasn't designed to process this volume of stimulation. Each red candle triggers a microdose of cortisol. Each volume spike creates a tiny fear response. His reptilian brain screams, "Get out. Get out now." So David does what amateurs always do. He manages risk by tightening his stop from 41.50 to 42.80, just to be safe. Another red 15-minute candle forms. Price touches 42.85. His new stop triggers. He exits for a $112 loss, feeling relieved that he avoided something worse. 2 hours later, the stock is trading at $45.20. The 1-hour breakout confirmed exactly as planned. His original stop at $41.50 never even came close. The lowest the stock went was $42.09, a normal retest of the breakout level on the hourly structure. David repeats this pattern 4 times that week, 4 trades where he plans on the 1 hour, but panics on the 15-minute. Total damage, $320. Not one of his original 1-hour stops would have been hit. He thinks he's being cautious. In reality, he's noise addicted. The 15-minute chart hijacks your brain through 3 specific psychological mechanisms that you must understand to survive. First, it accelerates emotional feedback. Think about the math. On a 1-hour chart, you see 6 candles per trading day. 6 moments where price settles and forms structure. 6 data points to evaluate. Your brain can handle 6 decisions. On the 15-minute chart, you see 26 candles, 26 microdramas, 26 opportunities to feel fear, hope, greed, and doubt. Your prefrontal cortex, the part that makes rational decisions, gets overwhelmed. By the 3rd hour of watching 15-minute candles, you're not analyzing anymore. You're just reacting. Every tiny move feels significant because your brain interprets increased information flow as increased danger. More data equals more threat. So even though nothing has changed about your trade thesis, your emotional state has completely shifted from calm confidence to anxious vigilance. This is the technical trap that kills more good trades than bad analysis ever could. A pattern that's clean and obvious on the 1 hour looks chaotic and broken on the 15-minute. You never let setups complete their natural development. If you're reading a book, you don't switch to a different book every 3 pages and expect the plot to make sense. Yet that's exactly what you do when you plan on the hourly and execute on the 15-minute. You're confusing the narrative. You're trying to read the sentence by staring at the ink molecules instead of the words. David's breakout at $43.50 needed time to confirm on the 1-hour structure. Real breakouts don't go straight up, they breathe. They pull back to test the level, then push higher with volume. That breathing looks healthy on the 1-hour chart. On the 15-minute chart, that same breathing looks like dying. More candles equal more perceived opportunities. The 15-minute chart creates an illusion of actionable information. You see a support level at $42.80 that holds twice on the 15-minute chart. You think, that's structure. But it's not. It's just where a few buyers happen to show up for 20 minutes. It has no institutional weight, no multi-day history, no real significance. Real levels are built over time. They show up on the 1-hour and daily charts because they represent actual supply and demand zones where big money makes decisions. The 15-minute chart is full of fake levels that look real but evaporate under any serious pressure. You spread your capital across signal and noise, and you can't tell the difference anymore. Here's the paradox that breaks most traders. The shorter your time frame, the longer you're suffering. The 15-minute chart turns you into a day trader with a swing trader's capital requirements. You need the patience of a position trader, because real wealth compounds over time, but you're operating with the attention span of a scalper. You need the capital to absorb 20 small losses, but you're risking like someone who only takes 3 high-conviction trades per week. When you drop down to the 15-minute chart, you're voluntarily entering the arena with high-frequency algorithms and market makers. That's their turf. They can paint candles to trigger your stops. They can create noise that looks like signal. But they cannot easily manipulate the 1-hour structure. It takes too much capital, too much volume. Professionals understand this maxim. Every time frame tells a different story. Mixing them without rules is financial suicide. The 1-hour chart tells you where the market wants to go. The 15-minute chart tells you how scared people are on the way there. If you use the 15-minute to override the 1-hour, you're letting fear overrule structure. David's $320 loss that week wasn't bad luck. It was predictable. It was the cost of time frame confusion, and it's a cost that compounds every single week until accounts go to zero. Here's your homework. Go back through your trading journal. Circle every trade where your exit was driven by lower time frame fear, not higher time frame invalidation. Add up those numbers. That's the tuition you've been paying to the 15-minute chart. That's the cost of watching the wrong movie while your real trade plays out on a different screen. The 15-minute chart isn't your enemy. Your relationship with it is. You're giving it a job it was never meant to have. You're asking it to act as risk manager and confirmation engine when it's really just a tape speed display. In the next chapter, I'll show you why the 1-hour chart acts like a lie detector for the market, how it filters out 80% of the fake moves that look terrifying on the 15-minute but mean nothing in the bigger picture. Once you see how the higher time frame exposes the truth behind the noise, you'll never look at those frantic little candles the same way again. The 1-hour chart doesn't show you more information, it shows you better information. And that difference is worth millions. Most amateurs think the answer is to add more indicators, more screens, more data. They believe that if they can just see every tick, every micro movement, every slight shift in sentiment, they will somehow gain an edge. They're wrong. In trading, clarity isn't about seeing everything. It's about seeing what matters. The 15-minute chart is a fire hose of raw data, most of which is irrelevant noise. The 1-hour chart is a filter that strips away the market's emotional outbursts and leaves you with structural truth. When you zoom out to the 1-hour time frame, you stop reacting to the market's mood swings and start understanding its personality. You move from being a spectator at a chaotic street fight to a general observing the battlefield from high ground. Here are 3 specific things the 1-hour reveals that the 15-minute buries, and understanding them is the difference between churning your account and building wealth. First, real support and resistance levels. This is where most traders get slaughtered because they're defending fake levels. On the 15-minute chart, every bounce looks significant. Price touches a level, buyers show up, it bounces. Your brain registers, support level found. Price hits $47.80 and turns up, you draw a line. It hits $48.10 and drops, you draw another line. By the end of the day, your chart looks like a spider web of horizontal lines, none of which actually mean anything. But that $47.80 level exists only because a few short-term players happen to show up in that slice of time. It hasn't been tested by serious money, it hasn't survived overnight gaps, it hasn't lasted through a news cycle. It's just a moment, not structure. On the 1-hour chart, only levels that matter across time show up with clarity. If a stock holds $47.50 3 times over 2 days on the hourly chart, that's structure. That level has been tested by multiple sessions, different market participants, varying volume conditions. It has survived morning volatility and afternoon chop. Institutions have placed orders there. Algorithms have marked it. That level has weight because it tells you institutions are defending that price. If it bounces once at $47.80 on the 15-minute, that's noise. One buyer, one moment, one temporary imbalance. It might hold for 30 minutes. It might break in 5. You have no way to know because it hasn't been tested by time. Professionals wait for levels that have been tested by time, not just tested by minutes. A level that holds for 4 hours has 16 times the significance of a level that holds for 15 minutes. Why? Because it has absorbed more selling pressure. It has proven that buyers are willing to step in repeatedly. Here's the practical difference. You enter long at $48 with your stop at $47.40 based on 15-minute support. The stock drops to $47.50 and your stop triggers. You lose $75. But the real 1-hour support was at $46.80, a level that had held for 3 days. If you'd placed your stop there, you'd still be in the trade. The 15-minute level was an illusion. The 1-hour level was reality. This is why amateurs get stopped out of winning trades. They're defending fake levels, while professionals lean on the backs of institutions. Second, true trend structure. The 15-minute chart shows you chaos. The 1-hour shows you order. This is the most visually striking difference when you finally make the switch. A stock can whipsaw for 3 hours on the 15-minute chart, up, down, chopping out stops in both directions and look like a bloody battlefield. 10 red candles, 8 green candles, long wicks everywhere, volume spikes that go nowhere. You stare at that chart and think, this is a mess, I don't know what's happening. But switch that same chart to the 1-hour view. What looked like a war zone suddenly becomes a clean consolidation. 3 hours of 15-minute chop condenses into just 3 hourly candles moving sideways under resistance. 4 or 5 candles stacking sideways under resistance. higher lows quietly forming beneath, volume contracting, then slightly expanding. It's not a panic attack. It's a pressure cooker. You can't pyramid into chaos. If you try to add to your position based on 15-minute signals, you'll constantly be adding at the top of the chop and getting stopped out at the bottom. You can only pyramid into structure. The 1-hour chart gives you the clarity to see where the real higher low is, allowing you to add size with conviction rather than hope. Imagine a stock trending from $52 to $58 over 2 days. On the 1-hour chart, it's a beautiful stair-step pattern. 5 clean hourly candles making higher lows. Each pullback holds the prior breakout level. You can see exactly where to add to the position at each successful retest of the rising support line. On the 15-minute chart, those same 2 days look like madness. Dozens of candles. Multiple false breakdowns. If you're managing that trade on the 15-minute chart, you exit 5 times. If you're managing it on the 1-hour chart, you hold and add. Same stock. Same move. Different outcome, based purely on perspective. Third, volume that actually matters. Volume is supposed to confirm price action, but on the 15-minute chart, volume lies constantly. Volume spikes on the 15-minute are often algorithmic noise or single large orders, a hedge fund rebalancing, a pension fund entering a position, a market maker covering inventory. One big order hits, one fund rebalances, one algorithm fires, and suddenly you get a candle with giant volume and a dramatic wick. When volume surges and price breaks a key level on the 1-hour chart, you have institutional confirmation. That's not one buyer. That's sustained buying pressure over 60 minutes from multiple participants. It takes a lot of money to keep volume elevated for 60 minutes. It takes conviction. When it happens on the 15-minute chart, away from any major 1-hour or daily level, you have a coin flip at best. Here's the scenario that exposes this difference and will change how you see every breakout for the rest of your trading career. A trader sees a stock break above $38 on the 15-minute chart with what looks like strong volume. The candle closes at $38.20. He thinks, that's my breakout, and enters long, full of adrenaline. 15 minutes later, the price is back at $37.06. His tight stop gets hit. He's out, frustrated, muttering about fake-outs and manipulation. What he missed is simple. On the 1-hour chart, $38 wasn't the breakout level at all. It was just a local high within a larger consolidation. The real resistance level, the one established over the last 3 days, was at $39.20. That's where price had stalled 3 separate times in the past week. That's where the real sellers lived. That's where real confirmation would have been. The 15-minute chart tricked him into a premature entry because it magnified a minor move into a major event. The 1-hour chart would have told him, not yet. Wait. This move is still trapped inside the cage. 2 hours later, on the 1-hour chart, a candle finally closed above $39.20 with a clear volume surge across 3 consecutive 1-hour candles. That was the real breakout. The stock ran to $42 over the next 2 sessions. The amateur caught the fake move and lost money. The professional waited for the real one and made $2.80 per share. Same stock. Same day. The only difference was time frame discipline. This brings us to a critical maxim that separates professionals from perpetual losers. Confirmation requires time to prove itself. The 1 hour gives price room to breathe. Think about what confirmation actually means. It means price has done something, held that action, and proven it wasn't a fluke. On the 15-minute chart, holding means 10 minutes. That's not confirmation. That's a pause. On the 1-hour chart, holding means 60 minutes of sustained behavior. That's proof. The amateur enters on excitement. He sees a big green candle on the 15-minute chart, and his brain floods with dopamine. He thinks, it's moving. I need to get in before I miss it. That urgency is your enemy. That fear of missing out is what market makers exploit. The professional enters on confirmation. She sees the 1-hour structure, identifies the real breakout level, waits for price to prove itself across time, then enters with conviction. No urgency, no fear of missing out, just patient execution of a plan built on structure, not emotion. When you trade the 1-hour chart, you're essentially saying, I'm willing to give up the first 2% of the move to ensure the next 10% is real. That's the trade-off. You sacrifice the absolute bottom, or the perfect entry price, in exchange for probability. You pay a premium for certainty. And in this game, certainty is the only thing worth paying for. Think about the psychological relief of this shift. Instead of making 16 decisions a day, you're making 3 or 4. Instead of your heart racing every 15 minutes, you're calmly checking the close of the hourly candle. The 1-hour chart acts as a natural filter for your own bad habits. It forces you to slow down. You physically cannot overtrade if you're waiting for hourly closes. And confirmation only appears when you step back from the microscope. When you're zoomed in on the 15-minute chart, every move looks significant. When you zoom out to the 1 hour, the noise disappears. What remains is signal. The real levels, the real trend, the real volume. Everything you need to make high-probability decisions without the emotional chaos of watching every tick. In the next chapter, I'll give you the exact 3-rule system I use to never confuse noise with signal again, and how to build positions only when the 1 hour gives you permission. These 3 rules are simple, but they'll eliminate 80% of your bad trades overnight, because once you stop trading noise and start trading structure, everything changes. Here's the system that saved my trading. 3 rules. No exceptions. No gray areas. No this time is different exceptions that slowly erode your discipline until you're back to gambling. Follow them, and you'll never confuse noise with opportunity again. These aren't complicated mathematical formulas or exotic indicators that require a PhD to understand, but they do require something most traders can't give: the discipline to follow a hierarchy even when your emotions are screaming otherwise. When I finally committed to these rules after years of self-sabotage, my win rate didn't magically spike overnight. But my average loss shrank dramatically, my average winner grew substantially, and my emotional volatility dropped by half. I went from reacting to every market twitch to actually running a systematic process. No trade unless the 1 hour confirms direction. This means 0 entries based on 15-minute breakouts, dips, or cute little setups unless the 1 hour chart explicitly agrees. Not mostly agrees. Not looks okay if you squint. Explicitly confirms direction. If the hourly is sideways, you wait. If it's trending down, you don't hunt for long entries no matter how oversold the 15-minute looks. If it's trending up and the 15-minute pulls back, that's potential entry timing, but only if the hourly structure supports it. Think of this hierarchy like a parent and child relationship. The child might scream that it wants candy right now. That's your 15-minute breakout signal demanding immediate action. But unless the parent says yes, the answer is no. The 15-minute is for timing. The 1 hour is for permission. Never reverse that hierarchy. Here's what this looks like in practice. You're watching a stock consolidating between $64 and $67 for 3 days. On the 15-minute chart, you see what appears to be a perfect bull flag forming. Tight consolidation, higher lows on the 15-minute. Volume drying up. Every fiber of your being wants to enter long in anticipation of the breakout because it looks so clean on the lower time frame. But you check the 1 hour chart first. It's still sideways. No breakout. No clear directional bias. Just choppy, range-bound action between those same levels. Rule 1 says, no permission granted. You don't trade it. You wait, even though it feels like you're missing something. 2 days later, the 1 hour finally breaks above $67 with a strong close and volume confirmation. Now, you have permission. The 15-minute chart might show you the exact moment to enter, maybe on a slight pullback to $67.20 for a better price. But the 1 hour gave you the green light to be in the trade at all. This single rule eliminates what I call phantom setups, patterns that look perfect on lower time frames but exist inside larger structures that haven't resolved yet. You're essentially trading inside someone else's consolidation, which is financial suicide. Most traders do this backward. They find a 15-minute setup they like, then check the 1 hour to confirm what they already want to believe. That's not analysis. That's rationalization. Your stop loss lives on the 1 hour structure. This is where most traders bleed to death slowly, one tiny cut at a time. The amateur puts his stop just below the last 15-minute low because it feels tight and appears to limit risk. He thinks smaller dollar risk equals better risk management. He's wrong. The professional puts his stop below the last 1-hour swing low, or better yet, below the key support level on the hourly chart that has actual institutional significance. Why? Because the 15-minute chart will shake you out on normal market volatility. Markets breathe. They inhale and exhale. The 15-minute chart captures those shallow breaths, the noise, the random algorithmic activity, the stop runs designed to separate weak hands from their money. If you place your stop based on 15-minute structure, you're placing it right in the noise zone where normal market movement will trigger it. The 1 hour gives you room to be right. When you place your stop based on 1-hour structure, you're saying, I'll stay in this trade as long as the thesis remains valid on the time frame where I found the setup. That's logical. That's professional. That's giving the market the room it needs to prove your idea right or wrong. Tight stops feel safe because the dollar loss is small if hit. They're expensive because they get hit 5 times as often. You risk $50 per trade instead of $200, thinking you're being conservative. But you get stopped out 4 times before the 5th trade finally works. You've lost $200 anyway, plus commissions, plus the emotional toll of 4 consecutive almost right trades that never got a chance to develop. As Jesse Livermore said, losing money is part of the game, but losing money on stops that are too tight is just bad craftsmanship. He understood that the market needs room to operate. Your stop should be placed where the trade idea is actually invalidated, not where you feel emotionally comfortable. Here's a concrete example that shows the mathematical impact. You enter a stock at $73 after a clean 1-hour breakout. The last 1-hour swing low is at $70.50. The last 15-minute swing low is at $72.40. Where do you put your stop? The amateur puts it at $72.30, just below the 15-minute low. He calculates, if I risk 70 cents per share, I can buy 400 shares with my $280 risk budget. The stock pulls back to $72.35 during normal intraday volatility, not even a significant move on the 1-hour chart. His stop triggers. He loses $280. The stock never goes below $72.220 and closes the day at $75.80. The professional puts the stop at $70.30, just below the 1-hour swing low. With the same $280 risk budget, he can only buy 103 shares because he's risking $270 per share. Same pullback to $72.35 doesn't even register as a concern because the 1-hour structure remains intact. He holds. The stock closes at $75.08. He makes $288 on his smaller position. Same stock. Same day. Same entry. The amateur paid $280 for the privilege of being right about direction, but wrong about structure. The professional made $288 because he gave the trade room to breathe within the time frame that mattered. Rule 3. If the 1-hour structure breaks, you exit, regardless of what the 15-minute shows. This is the discipline rule that separates professionals from amateurs who occasionally get lucky. You're long a stock. The 1-hour shows a clean uptrend with higher highs and higher lows. Everything working perfectly. Then the hourly breaks below its rising support line with expanding volume. You exit. Immediately. No hesitation. No second guessing. Even if the 15-minute chart looks fine. Even if the 5-minute shows a bounce forming. Even if you feel it'll recover. Even if you're only up 2% instead of your 8% target. The 1-hour is the boss. When it says the trade is over, the trade is over. This rule protects you from the most expensive mistake traders make, holding losers because lower time frames give you false hope. The 15-minute chart will always show you reasons to stay in a failing trade. A support level here, a volume spike there, a reversal candle that looks promising. Your brain, desperate to avoid realizing a loss, will latch on to these signals like a drowning person grabbing driftwood. But if the 1-hour structure has broken, if the pattern that gave you permission to enter has now invalidated, those 15-minute signals are irrelevant. You're watching the wrong movie while your account burns. Here's how all 3 rules work together in a complete scenario. You're tracking a stock in a strong 1-hour uptrend. Clean higher lows over the past week. Each pullback holds the prior breakout level. Resistance at $51.20 has been tested twice with decreasing volume, classic coiling action. Rule 1 says, you have permission to trade long when this level breaks with confirmation. The 1-hour candle closes at $51.40, breaking above $51.20 with a 30% increase in volume over the average. You enter at $52 right at the market open. Your stop goes at $49.80, just below the prior 1-hour swing low, which also aligns with the rising trend line. Rule 2 in action. Stop based on 1-hour structure, giving the trade room to work. The next day brings a test. The 15-minute chart shows a sharp dip from $52.80 down to $51.40 in 20 minutes. Heavy volume, long lower wick that looks terrifying on the lower time frame. Every amateur watching that 15-minute chart is hitting the sell button, convinced the breakout is failing. But you check the 1-hour structure. The current hourly candle shows a low of $51.40, right at your entry level, but it's still well above your $49.80 stop. The rising support line hasn't broken. The 1-hour structure remains completely intact. You hold, trusting the system that got you into the trade. 3 days later, the stock hits $57. You exit half your position, locking in a $5 per share gain. You trail your stop on the remaining half to $55, just below the most recent 1-hour swing low, letting the remainder ride the trend. Now imagine the same scenario managed on 15-minute discipline. You buy at $52. Price dips to $51.40. Your tight 15-minute based stop at $51.35 gets hit. You're out with a small loss, watching from the sidelines as the stock does exactly what your 1-hour analysis predicted, rallies to $57. You were right about everything except time frame hierarchy. The amateur optimizes for activity. He wants to do something when the chart moves against him. He equates action with control, clicking buttons with competence. The professional optimizes for accuracy. She wants to do the right thing at the right time, based on the right time frame. She equates discipline with control, understanding that most of the time the best action is no action. These 3 rules form an unbreakable chain of logic. Rule 1 ensures you only trade when the higher time frame gives explicit permission. Rule 2 ensures you give those high-probability trades room to work without getting shaken out by noise. Rule 3 ensures you exit when the higher time frame structure actually breaks, not when lower time frames create temporary fear. Follow this system religiously, and you'll find yourself taking dramatically fewer trades, much fewer. Your friends will think you're not active enough. Your emotions will tell you you're missing opportunities. Ignore both. The trades you do take will have higher win rates, larger average winners, and lower emotional cost. You'll stop churning your account on mediocre setups and start building positions that actually compound your capital over time. The amateur optimizes for activity and tight stops, trying to outsmart every wiggle in the tape. The professional optimizes for accuracy and structural breathing room, letting the market do the heavy lifting. And accuracy comes from letting the right time frame guide your decisions, not the loudest time frame, not the most active time frame, but the one where you found your setup and calculated your risk. In the final chapter, I'll show you the exact mathematics of why trading less actually makes you more money, and how this simple shift from 15-minute chaos to 1-hour clarity compounds into life-changing results. The numbers will shock you because they reveal how much money you've been leaving on the table by trading the wrong time frame. Once you see the math, you'll never go back to the noise. Here's the paradox that separates amateurs from professionals. The fewer trades you take, the more money you make per trade. And the more you make per trade, the less you need to trade. This sounds completely backward to most people. Your brain has been conditioned by every other profession to believe that more activity equals more results. More hours worked means bigger paychecks. More clients served means higher revenue. But trading isn't labor. Trading is decision-making. And in decision-making, quality trumps quantity every single time. The market doesn't pay you for participation. It pays you for precision. Most traders never even test this principle. They assume more trades equal more opportunity, more shots on goal, more chances to hit winners. They build their entire identity around being active, always scanning, always clicking, always in something. But markets don't reward activity. They reward accuracy and patience. The mathematics will prove this to you in ways that will either liberate your trading or completely offend your need to feel productive. Let me show you the exact mathematics that changed my life and the lives of every professional trader I know. Trader A watches the 15-minute chart religiously. He takes 12 trades per week, risking $500 each. He's not reckless. He has rules, discipline, a plan. He wins 6, loses 6. Win rate 50%, which sounds reasonable. Average winner's 6 and 50 because he takes profits quickly. Afraid each winner will reverse. Average loser $500 because his tight stops get hit cleanly. The weekly math: 6 winners times 650 equals 3,900 in gains. 6 losers times 500 equals $3,000 in losses. Weekly profit $900. Trader B watches the 1-hour chart exclusively. Takes 3 trades per week, risking $1,200 each. She wins 2, loses 1. Win rate 67%. Average winner $2,800 because she holds through normal volatility that would have scared Trader A out. Average loser $1,200 when the 1-hour structure actually breaks. The weekly math: 2 winners times 2,800 equals $5,600 in gains. 1 loser times $1,200 equals $1,200 in loss. Weekly profit $4,400. Same capital, different time frame, 5 times the profit. But let's dig deeper into what those numbers really mean, because hidden inside them is the key to professional level wealth building. Trader A's expectancy per trade is microscopic. He makes $900 on 12 trades. That's $75 per trade on average. His risk per trade is $500. So he's making $75 for every $500 he risks. That's an expectancy of 0.15 R. For every unit he risks, he earns back 0.15 units. That's barely above random, and after commissions and slippage, it's probably break even at best. Trader B's expectancy tells a completely different story. She makes $4,400 on 3 trades. That's approximately $1,467 per trade on average. She risks $1,200 per trade. So she's making $1,467 for every $1,200 she risks. That's an expectancy of 1.22 R. For every unit she risks, she earns back 1.22 units. That's the difference between grinding and growing. Now zoom out to monthly numbers, because this is where the compounding becomes obvious. 4 weeks of Trader A, $900 times 4 equals $3,600 monthly profit. 4 weeks of Trader B, $4,400 times 4 equals $17,600 monthly profit. That's a $14,000 monthly difference from the same starting capital, simply because of time frame choice. Over a year, Trader A makes $43,200. Trader B makes $211,200. Same person, same market, same basic strategy, just different time frames driving the decisions. Why does this work? Because the 1-hour chart forces you into what I call intelligent undertrading. You see fewer setups, which initially feels like missing opportunities. Your brain screams that you should be doing more, trading more, participating more. But those fewer setups have dramatically higher probability because they're built on structure that has been tested across time, not just minutes. You size bigger because you have genuine conviction. You hold longer because you're not getting shaken out by normal market breathing that looks catastrophic on lower time frames. The 15-minute chart seduces you into expensive overtrading. Every wiggle looks tradable. Every bounce off a minor level feels like opportunity. Every volume spike appears to be institutional confirmation. You spread your capital across too many mediocre bets, diversifying across noise instead of concentrating into signal. Even with a decent win rate, your position sizes are too small to matter because you're treating every setup equally when they're not equal at all. Here's the hidden psychological cost that nobody talks about. Trader A makes 12 emotional decisions per week. 12 moments where fear can override logic. 12 opportunities for his amygdala to hijack his prefrontal cortex. 12 times his heart rate spikes and cortisol floods his system. By Wednesday, he's emotionally drained. By Friday, he's making decisions just to feel productive, not because high-quality setups exist. Trader B makes 3 key decisions per week. 3 moments of execution. The rest is patience, watching, waiting. When she does act, she acts with full conviction because the 1-hour chart has given explicit permission. Her error rate is lower because she's not making decisions in a state of decision fatigue. Think about the mathematics of decision fatigue. Research shows that decision quality degrades exponentially with the number of decisions made. A judge is more likely to grant parole in the morning than in the afternoon simply because mental energy depletes. Your trading decisions follow the same pattern. Decision 12 is not as good as decision 3, no matter how disciplined you think you are. This shift isn't just about charts or timeframes, it's about identity transformation, and this is where most traders get stuck. When I called myself a day trader, that label carried psychological baggage. It implied that if I wasn't trading every day, I wasn't doing my job. It made me feel guilty on slow days when no quality setups appeared. It forced me to manufacture trades out of boredom and the need to justify my screen time. When I stopped calling myself a day trader and started thinking like a 1-hour operator, everything changed. My job was no longer to be active. My job was to execute 1-hour structures with discipline and patience. Some weeks, the 1-hour chart only gave me one high-quality setup. I took it, sized it appropriately, managed it according to hourly structure, and that was the week. No guilt. No feeling like I missed something. I traded what the market gave me on the time frame that mattered. My stress dropped by half within the first month. I stopped waking up at 3 a.m., replaying trades. I stopped checking my phone during dinner. My win rate improved from 51% to 64% because I was only taking setups with genuine structural confirmation. But most importantly, my average winner grew from 1.2 R to 3.1 WAR because I gave trades room to develop instead of scalping out at the first sign of profit. That R multiple expansion is the secret to everything. When your average winner is 1.2 R and your average loser is 1 R, you need a 55% win rate just to break even after commissions. When your average winner is 3.1 R and your average loser is 1 R, you only need a 35% win rate to be profitable. The 1-hour chart naturally pushes your R multiples higher because you hold through normal volatility that would have stopped you out on lower time frames. Here are the hidden costs that Trader A pays that never show up in his P&L statement but destroy his performance over time. 12 trades per week means 12 round trips. 12 times paying the spread. Over a year, that's 624 trades versus Trader B's 156 trades. The friction costs alone can be thousands of dollars annually. The cognitive load of processing 26 15-minute candles per day versus 6 1-hour candles creates decision fatigue that compounds weekly. Time spent managing 12 mediocre trades could be spent finding 3 exceptional ones. Here's your protocol starting tomorrow morning. Print this out and tape it to your monitor. First, anchor your plan, risk and stops on the 1-hour chart. Every trade decision starts and ends there. If the 1-hour doesn't confirm direction, you don't trade. If it doesn't provide a logical stop level, you don't trade. The 1-hour is your foundation. Everything else is decoration. Second, use the 15-minute only for entry refinement, never for exit decisions. The 15-minute can help you time a better entry price within the 1-hour structure. But the moment you use it to question your stop placement or exit strategy, you've violated the hierarchy and returned to gambling. Third, size positions so 3 good trades per week can change your month. This is psychological as much as mathematical. If you need 12 trades to make meaningful money, you'll force trades that aren't there. If 3 trades can legitimately move your account, you can afford to wait for 1-hour confirmation. Fourth, track every time you betray the 1-hour plan. Keep a cost of disobedience journal. Every time you exit based on 15-minute fear when 1-hour structure was intact, write down the cost. Every time you enter on 15-minute signals without hourly confirmation, calculate the damage. At month end, total those betrayals. The number will shock you into discipline. Jesse Livermore, the greatest speculator who ever lived, didn't trade every day. He famously said, "It was never my thinking that made the big money for me. It was always my sitting." He waited, sometimes for weeks. He built positions slowly, pyramiding into strength only after the market proved his thesis correct. He let the big moves do the heavy lifting. He understood that the market pays you for patience, not participation. The market is a device for transferring money from the active to the patient, from the 15-minute watcher to the 1-hour operator, from those who need constant stimulation to those who demand structural confirmation. Stop watching the 15-minute chart. It's selling you anxiety disguised as information. Start watching the 1 hour. Trade only when the hourly confirms direction with volume and structural integrity. Size appropriately based on 1 hour stops. Then sit. Wait. Let the market reward your patience. And remember this final truth. Sometimes waiting is the most profitable position you can take. Waiting isn't doing nothing. It's building potential energy for the next high probability trade. The fewer better trades you take, the more each one matters, and the more your trading resembles a professional business rather than an expensive hobby. If this shifted how you think about time frames, if you're finally seeing why less can be dramatically more, the next video will show you how to pyramid into winning positions without giving back your gains. Because knowing when to add to a winner is just as important as knowing when to enter, and the 1 hour chart will show you exactly when the market gives you permission to press your edge. That's where amateurs stop and professionals accelerate.